The widening divergence in both performance and valuations of the markets of individual countries has been a notable feature of Asia's investment landscape over recent times. This is no more evident than when looking at two of the largest markets within the Asia-Pacific region, India and China, where the dispersion of returns has reflected the significant differences in the economic drivers, governing policy, and structural trends to which these two countries have been exposed. Against this backdrop, it is insightful to hear the candid thoughts of a portfolio manager with a mandate enabling a highly selective approach to investment in the region, and it's always an interesting discussion with Robin Parbrook at Schroders. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killik.com. In this episode, we were joined by Robin Parbrook, the head of Asia excluding Japan equities at Schroders. Robin has more than 20 years of experience covering Asia at the asset manager, and he's managed the open-ended Schroder Asia Total Return Fund since 2007. His team also took on the mandate for the London-listed Schroder Asia Total Return Investment Company, ticker ATR, in 2013, and this is managed to a similar philosophy. As you will soon hear, Robin is a highly selective fund manager, running a portfolio which can often differ markedly from broader Asian benchmark indices. A further differentiating feature of this portfolio is the use of a hedging overlay, whereby a modest exposure is at times given to instruments with the aim of dampening volatility, that variability of returns over time, and also removing some of the systematic risks associated with investment markets. This feature has aided risk-adjusted returns over the life of the strategy. We touch on this hedging overlay very briefly in the latter part of this interview, but it can involve securities benefiting from rising market volatility, commonly associated with the volatility index, often referred to as the VIX index, and also put options, contracts which give the buyer the option to sell a specified amount of a security, in this case, typically a specific country index or an area of the Asian markets, at a predetermined price, therefore benefiting the owner should weakness beyond this level be experienced. We hope you enjoy this discussion, but as always, please get in touch with us using the podcast email address if you would like any further details on any of the topics discussed in this episode. Robin, good afternoon. Thank you so much for joining us. How are you doing today?
Very well, thanks, Gordon. How are you?
Yeah, very well, thank you. So, Robin, we've got a kind of standard opening question to these discussions that we've been asking people, and its aim is to get a kind of a bit of an insight into you, really, or maybe something you've been working on, or kind of what your typical working week looks like. So, I wondered if there's maybe an anecdote from a recent company meeting, or an article or book you could share with us. Anything kind of interesting going on in your world at the moment?
Yeah, I mean, there's a couple of things we're working on. I mean, it's nothing that wouldn't be out of what we'd say would be the day-to-day normal things we work on, but it maybe gives the audience a little sample for what's happening in our world and in general world of investing, I suppose. So the two topical things I'm working on with my colleague Tom Clough at the moment is the Indian CDRMO sector, which might not mean too much to the audience, but CDRMO is what Lonza does. So it's a clinical development research and manufacturing organization. So it's where big pharma outsources parts of their more routine work, the manufacturing work, some of the research and development work to other companies. So Lonza being a classic example, Catalent, Boehringer would be other European and American companies that do it. Traditionally, that sector's been quite, at the lower end stuff, at level, been quite dominated by Chinese players and geopolitics. There's something going in the US Congress at the moment called the Biosecure Act, which has been slated, which is all about taking Chinese companies out of that supply chain. So if you're someone like Pfizer or Glaxo, and suddenly you've been outsourcing all this basic clinical development, research, and manufacturing work to Chinese players who are super efficient at doing it, you now need to find new supply chains. So what we're looking at is whether any of the Indian healthcare companies can compete in that space. Do they have the skill sets? So what that means is you're reading lots of articles. So Indian companies, of course, claim they've got all the skill sets, but Indian companies tend to always put a positive spin on things. So then you need to go and talk to your industry experts, talk to independent sources. The advantage we have at Schroders is we know these Chinese companies very well. We've been hurt, to be honest, in some of the Chinese companies because we have owned them because they're really good companies. But what we know from that is it's not actually that easier industry. You don't just suddenly turn up and you've got thousands of really well qualified pharmacists, and Indian pharmacists that are well qualified tend to not stay in India. They go overseas and work for Lonza, strangely enough. So the lead time for Indian companies to get there up to speed in this sector actually looks quite long. So, but that's kind of stuff we're doing at the moment. It's obviously where you're negotiating around geopolitics and stuff like that. The other thing we've been looking at and doing lots of work on, lots of debate within the team generally, is I know we're going to go on and talk about tech. I'm sure, Gordon, you're going to have lots of questions, but is AI applications. Can AI drive a new PC and smartphone cycle? Will we finally replace all those PCs and smartphones that we bought in 2020 and 21? Will there be any functionality that any of actually want for AI? Because as it stands today, I don't know about what it's like at Killik, but we're not finding a huge amount of bountiful uses for Chat GPT. It can automate a few things here and there, but it's certainly not going to make anyone any money because we're not going to pay much for it. So what's key at this point is we do actually find some AI applications that the consumer actually wants to use. So it'll be very interesting when the iPhone 16 comes out in September, whether Apple Intelligence, as Tim Cook's calling it, which is actually quite a nice thing because it's obviously has AI in it, whether that causes us to say, let's go and get a new iPhone and ditch your iPhone 12s that was the last really big boom in iPhone sales. But again, that's a similar kind of thing. We're doing lots of work talking about to tech analysts. I had a call end of last week with a Taiwanese company that does certification for chips. So it certifies. So this would be your earliest sign that you're starting to see AI applications, because it actually takes the chips that have the AI application, so the Qualcomm chip or the MediaTek chip, and actually then do the straight certification. Does the chip work? Is it safe, etc., etc. So far they're seeing a little bit of pickup, but nothing too dramatic, which maybe says, again, we can talk about it. We talk about tech, just a small flag of caution on some of the hype in the tech space.
They're very interesting, kind of peek into some of the projects you're working on. I'm sure we'll come back to some of those areas in terms of trade relations with China. And actually, it's a theme that's come up before, actually, on the AI applications and whether businesses might be kind of pausing for breath just to work out if they are going to spend a lot of money in this area, just exactly what they're spending it for. I think that's a theme that's come up in prior episodes. So very interesting. Robin, I thought what we do one of the kind of features of global markets, but also Asian markets, has been this kind of dispersion of returns, kind of whether it be kind of India versus China in Asia or tech versus some of the other sectors. So what I thought we'd do is maybe run through some of those kind of big component parts of the Asia market in turn and perhaps explore those. I wondered if we could start with China. And I think anyone that's kind of read some of your recent kind of monthlies would have kind of picked up on that kind of continued caution on Chinese markets. But I mean, it is a market that's fallen quite sharply. We are you kind of read around some of the market commentators and some of the other fund managers sort of picking up on a slightly more constructive stance maybe. But I wondered if I can ask you to talk through kind of where you're currently sat in terms of Chinese markets in general.
Yeah, I mean, Gordon, we've talked before. Actually, I think it probably was 10 years ago, and I'm sure I was negative on China then. And actually, was about 10 years ago because I think my daughter was quite young at the time, and she found the video on YouTube and sat and laughed at me. But anyway, moving back to what we're talking about today, we remain structurally cautious on China. We're not saying China's uninvestable. There's still some great companies in China. But if one was taking the overall market and the overall policy settings, and on the policy settings in particular, it's not a good backdrop for the market. I think we're in a primary bear market in China. The state is advancing. The private sector's in retreat. As it stands today, we know a lot more about how President Xi thinks than perhaps we did 10 years ago when he'd just taken over. He is much more Marxist, Leninist. He's a proper communist. Stock markets and communism are never going to be easy bedfellows. Stock markets require capitalism. So, that's, if you've set the backdrop, why structurally it's a difficult backdrop for China. And if you take more where we are in the cycle at the moment, obviously the property market's very, very difficult. We don't need to talk in depth on the property market, but the numbers are quite staggering if you're looking at the amount of supply, whether it's sold or unsold, whether it's completed or uncompleted. In total, the latest numbers I was looking at is there's 90 to 100 million units sitting completed or uncompleted, sold and unsold in China. And that's on a base of 300 million urban units. And obviously Chinese demographics are not particularly favorable for household formation. So this is a structural problem that will weigh on the consumer. Most of those units are actually sold and most of them are incomplete. So we've got several of our colleagues in Shanghai who are sitting waiting for units that may or may never be finished. And obviously they're very worried. And the way China works is you pay for your property in advance. So, there's multiple reasons why the consumer's under pressure. And then the policy setting to try and relieve this is primarily based around new productive forces, which I'm sure everyone in the audience or listening has heard of. And that's about building lots of shiny new factories, shiny new pieces of infrastructure to try and boost growth, because that's what communists tend to like to do. They invest heavily. And actually, let's be fairer on the Chinese authorities, that creates jobs. If you've got a job in China and you're fortunate enough not to have bought a property that's not been uncompleted and you've lost a lot of money on, so you're not in the property market, you're actually doing quite well because China's deflationary and your salary's going up. You've got a job. So in many ways, if you're President Xi, you're achieving his objectives, which is sharing wealth more evenly, getting Gini coefficients down, growing the economy. Unfortunately, because you're doing it by building lots of things and new productive forces, you're creating overcapacity in wide ranges of industries. That's very bad news for earnings, return on invested capital, and of course, stock markets reflect return on invested capital, not economic growth. So in a nutshell, that's why the stock market's not performing. I think there's still, the numbers I've got at the moment, the market's not that cheap because the EPS is coming down so quickly, a combination of deflation and excess capacity. And of course, the excess capacity, going back to the CDRMO sector we were talking about earlier, it creates geopolitical tensions. So Europe obviously puts on anti-dumping duties correctly, in my view, on Chinese EVs. US is going down a separate route, just saying they don't want China in their supply chains. You've got Indonesia, Brazil, Thailand, all talking about putting anti-dumping duties on Chinese goods. So it's not just a European and US thing, because China's trying to export its overcapacity. So it makes it, in a nutshell, a very difficult backdrop for the stock market. We're, as I said, don't think China's uninvestable. We were down this time just over a year ago when China was having its reopening bubble. We were down about 3 or 4% of the fund in China. We pretty much sold out into that. We're back to about 10% China today because obviously your point at the beginning, Gordon, everything's getting sold off now. We are at capitulation, so it is throwing up the odd good stock. I used to do Japan along with Asia back in the 1990s, and history doesn't repeat, it does tend to rhyme. There are parallels between Japan and China. There's plenty of differences too. But if you assume one of the similarities is they're both in bear markets, you could still make money in Japan in the 1990s, but you didn't make it by owning the index. You made it by owning the few good stocks that had secular growth and were in areas with secular growth or trends were in their favor. So that's what we're looking at in China. So as I said, at the moment, we've got about 9% of the fund in China.
Yeah, but very, very selective in what you're owning. Yeah, that makes sense. Thank you for laying that out. And I wondered if we could go to a kind of contrasting market, I guess, in terms of India, kind of starting, I guess, to see perhaps a bit of an inflection point in earnings growth there. And it's been a very, very strongly performing market. And obviously we had the kind of the excitement of the election result, the kind of surprise weak performance by Modi there, which the market seems to have shrugged off a little bit. I wondered, I mean, it is a market which is always priced quite richly, but does look a little richly value. Can you maybe talk us through again where you're seeing kind of where you're positioned there, if there's kind of opportunity again selectively in that market?
Yeah, Gordon. I mean, obviously we're touching on the second biggest market. China's actually a much easier market to talk about because our views are really quite, quite defined, and we can see what's happening in China. India is actually much, much trickier. So India, the macroeconomic picture, the structure outlook for growth and the stock market is undeniably positive. The elections were mixed. My own view is the elections were probably positive because Mr. Modi got a bit of a bloody nose. And what that means is we'll probably get a little bit more populism because it's a coalition government now. So he's got to pander to his two coalition partners. But actually, on a positive spin, we get less Hindu nationalism, which is not what really anyone wants and was probably deterring foreign investments. So that gets dialed down. So my own view is the market's reacted correctly to it. Overall, it's actually you could put a positive spin on it. And I don't think it changes the basic thrust of policy, which is pro-business, pro-economic reform, remains in place. So we actually we were hoping we were going to see a proper correction and we could add some things in India. We did manage to add a tiny bit, but it literally was a one-day wonder, the correction. So as of today, obviously the market's had a very strong run prior to the elections and now post-election. And the valuations are expensive on every measure you look at, whether it's versus India's own history. It's always been an expensive market, but it's now right at the top end of its long-term historic trading range. It's obviously very expensive versus the region. Most of the region's quite, outside tech in China is pretty depressed, and it's expensive in absolute terms, very expensive in absolute terms. Obviously, as I said, the macro is good. The earnings outlook, as you alluded to, Gordon, is actually quite positive. But there's little flags of caution, which I would say, for us certainly, we're not actually doing very much in India at all, but we certainly wouldn't be adding. There's lots of placements, lots of IPOs, some insider selling, and actually historically, when you get waves of IPOs and insider selling in India, strange enough, it does coincide with short-term market peaks. The other problem on the earnings side, the earnings outlook's positive, but sell side, the stockbrokers, to justify ever higher valuation in India, of course, they raise their EPS numbers. We always see that because they always chase upwards. So, the earnings are good, but the expectations and the earnings forecasts that the stockbrokers are plugging in to justify what are now very high valuations look pretty punchy. So I think the risk to earnings is actually now versus what are now very high expectations to the downside. So we still like our Indian private sector banks. We like healthcare, like Indian industrials, and that's enough to keep us within the fund. We have about 15% in India, which we're benchmark agnostic. I really don't care about the benchmark, but probably puts us slightly underweight. We are cautious on the consumer stocks because of valuations and competition, lots of competition coming in. Cautious on the infrastructure, auto, and the motorcycle stocks. So cautious on quite a lot of the areas where the valuations just got way ahead. And there is quite a lot of capital being deployed in India, which means you're going to get more competition, and the stocks are making historically high margins, which goes back to my point earlier. The risk at this point on the earnings side, given the high expectations, is possibly to the downside. But the long-term picture, undeniably, is good for India at a macro level. So if we do see any big corrections in stocks we like, we would be looking to add probably.
Yeah, no, that's helpful. Thank you for that. Robin, I wonder if I could drag you back to the kind of the technology areas. And I mean, the fund's obviously benefited from some of these kind of AI related companies, things like TSMC, for example. But I mean, again, it's one of those areas that we have had a strong run, kind of those expectations have kind of risen in some of those areas. And as you referenced in an earlier question, we're kind of navigating a period where we've got elections coming up in the US and kind of that talk of trade relations. And it's an area which is clearly sensitive to some of those discussions. I wonder kind of how are you navigating some of these areas at the moment as we kind of approach that US election?
Yeah. So tech at the moment, we tend to avoid, because politics are obviously a fairly random walk, as we know at the moment. Who knows whether Mr. Biden or President Biden stands or not, et cetera, et cetera. So obviously you do your scenario analysis, but we don't tend to try and put that into too much of what we're trying to analyze, because it just becomes too painful and depressing if you think Trump gets back into the White House, let's face it. So where are we in the tech cycle? Probably is the more interesting one for us, because for us in Asia, it's semiconductor stocks that we own in Asia. So that's the memory stocks in Korea and the foundry stocks in Taiwan, TSMC being the obvious one, because it's by far and away the biggest stock in Asia, more than 10% of our benchmark now. So where are we in the cycle? These are cyclical stocks. So in terms of where we are, in terms of the revenues, the stocks tend to track the revenues. We're actually probably midpoint through the cycle, and the stocks themselves are definitely discounting, obviously, quite a strong cyclical pickup. So I would say we're at least midway through the cycle from a stock perspective. So to be rushing out to buy these stocks now, particularly anything that's been caught on an AI bid, you would have to be saying this time is different, the four most dangerous words in investing, or stronger for longer, three very dangerous words as well. Which goes back to what we were really discussing at the beginning, why we're looking at these AI applications. Is there enough there to drive a PC replacement cycle, an iPhone replacement cycle? Because we really need that for the stocks to do further. And that's, as I said earlier, we're still coming down to, we haven't really formulated our conclusions. I actually think we will get a reasonable replacement cycle on our iPhones. So on that basis, we're still happy running with our positions in Asia. They are the biggest positions in the fund. The fund is more than 30% in tech. It's a big part of our Asian benchmark. But what we're not doing is we're not chasing AI themed stocks that do liquid cooling or make racks for server farms and things like that. That looks way overhyped. But we're sticking with the key semiconductor names. We like some of the packaging companies and areas around that. The other stocks always worth a look and following, but these are more late cycle on but we would need them to start seeing orders again to get excited, are the software companies. So in our universe, it's the Indian IT companies. In overseas funds, it'd be obviously stocks like SAP and Accenture and Salesforce or whatever. And they're actually seeing slow sales, which I think goes back to what you were highlighting earlier, Gordon. What we're actually seeing at the moment is people are spending lots of money on hardware, and companies themselves aren't sure, is AI big or what are we going to do with it? So they've actually pulled back on their IT spend. So it's really quite a mixed picture on our tech stocks. So if you were asking me what we're going to do if the stocks remain strong, we will be selling into the second half if they remain strong. And the risks are now, I hate to sound downbeat because I've also been downbeat in India as well. So we have been adding to China, even though we don't like it. So we're not downbeat and everything. But and the risks of the tech side at this point, I think, had such a strong run. In my mind, the flags of caution are there.
That's really helpful in kind of understanding what you're thinking about that sector. Robin, I wanted to talk about the hedging strategy, because it's kind of it is the area that differentiates the strategy so much, and it's been so helpful in kind of improving those risk-adjusted returns over time. Could you maybe kind of talk us through kind of how you think about the hedging strategies, maybe a summary of kind of what goes into that kind of model, and to what extent you're kind of hedging at the moment, if you could?
Yeah, no, good question. So just to recap, there's two models we use for hedging in the Asian Total Return Fund. There's one we call our long-term country models, and there's one we call our CARP model, which is a short-term, more tactical model. So looking at the long-term model first, which we run for each of the major stock markets in Asia, it's basically a dynamic version of Campbell and Schiller. So we assume that markets over the long term will mean revert back to standard valuation metrics. But what my colleague, it's my colleague King Fui and myself run the fund. King Fui's background is econometrics and statistics. He's the bright one. He puts in lots of business factors. So we're saying at this point in the business cycle, typically what would be the 1 to 2 year returns you'll get from the market. So if we went back this time about 9 months ago, those models were neutral to positive in most of the Asian markets. I'm afraid to say, I'm telling you like a rule. I'm trying to talk myself out of a job here, but those long-term models, it is quite interesting. Just in the last 2 or 3 months, have turned more cautious. So having been relatively positive towards the end of last year, obviously strong moves in markets, particularly year to date, we've actually seen, with the exception of the tech space, material downgrades in Asia. So particularly obviously in China, but we've seen earnings downgrades, across quite a lot of the markets, the ASEAN markets, Australia, you've seen on average downgrades. So that's meant for many countries, the combination of some earnings downgrades, strong market moves, the models are flagging caution that we won't make much money on an 18-month basis based on mean reversion, based on where we are in business cycle, because the business cycle indicators have ticked over as well. So that's the predictive power that earnings aren't going to be great. It varies from country to country. China looks particularly weak on its business cycle indicators, which would be obviously consistent with why the earnings outlook is cloudy, to say the least. The CART model, the short-term model, is a little bit more upbeat. So we run the models monthly because they pick up monthly data points. The tactical model looks at an economic surprise index, sentiment measures, financial distress, some technical indicators, and commodities, because Asian economies tend to like falling commodity prices. And that then figures in and says, when these readings are closest to where they are currently versus history, how have markets performed? What's the probability of markets rising? And what's the average rise or fall? And it takes data going back to 1990 to see, based on historical trading patterns, what's the most likely outcome for markets. And it looks at the overall Asian index. That model at the moment is neutral. It was positive until last month. It's just rolled over as well. The reason it's rolled over is the economic surprise index has turned negative again, which is quite, consistent with what we're seeing. So measures of financial distress and inflation are still benign, but the model's saying historically, when you've got the current readings, current valuations, you don't make much money in Asia. It's a 50-50 probability markets rise and fall over the next 3 to 6 months, and the average rise or falls actually -1 actually, so it's a slight negative reading. So anyway, they've turned more cautious. So putting that all together, what does that mean we do for the fund? We haven't had much hedging in place for the strategy really for the last, since 2022, if one wants to go back ancient history, when China had its first really big wobble around the NPC, the National Party Congress. Asian markets, again, with the exception of India and tech, have been out of favor. So we haven't had much hedging in place. At this point, we are we've got some VIX call options, and we've been looking to buy puts when pricing's attractive. So we like buying puts because they're a measure of complacency. When puts are cheap, it tends to be because markets are strong, things are great. So obviously, US market remains quite strong. VIX is low, put pricing is actually quite reasonable. So we're very happy buying some tail risk protection in the fund. So it's still relatively modest, but we are building up. And that just reflects, obviously, from what we've been saying for the last 20 odd minutes, the general caution that we have on the key sectors within Asia at the moment. We're not negative in everything.
Opportunity. Yeah, Bobby, the last question that we've kind of got a standard open and a standard closing question. It is one that kind of ends on a more positive area. It's one that asks the speaker for their kind of highest conviction area at the moment. So I wondered if there's one particular, whether it's a sector or kind of an area you might be able to highlight as being one area that you are kind of selectively positive on at the moment. What would that be?
Yeah. So the key, I would say, the message for the audience takeaway is there's more to Asia than China. Thank goodness. So otherwise, obviously, I wouldn't have a job. But we are investing in a fantastic, dynamic region with lots of different drivers. So there's obviously tech, there's China, there's India. You can treat them almost as separate asset classes. The bits where we're seeing the best opportunities at the moment, actually, and I was saying the other thing to take away from Asia is more than just China, but actually, historically, 60 to 70% of your returns in Asia have come from reinvesting your dividend yields. So there's loads of good stocks in Asia with big dividend yields. And it's not just banks. You can buy Aussie healthcare, there's Aussie industrials. There's lots of interesting stocks in ASEAN, or consumer stocks. ASEAN markets is Thailand, Indonesia, Philippines, almost the forgotten markets. Small parts, some are indexed, but there's some great consumer businesses there. The economy in Indonesia and the Philippines are ticking along fine. These are well-run companies, fairly oligopolistic with big dividend yields. 60, 70 returns come from dividends. So I think looking for good yielding stocks that have the potential for moderate capital appreciation, because valuations in Australia, Singapore, Thailand, Indonesia, Philippines really are quite low. I'm seeing lots of opportunities there. So as we possibly take money out of the tech space, possibly India, that's where we're looking to add money. And, I would say the Asian Total Return Fund's called the Asian Total Return Fund because we're agnostic whether our return comes 70% from dividend yields, 30% from capital appreciation, or 30% from dividends, 70% from capital appreciation. But there is value out there in the region. It's just not in the areas that everyone's talking about at the moment, to be honest.
Yeah, no, thank you for that. No, they're a good sign of governance when those businesses are kind of returning capital as well. So those kind of dividend payers are kind of a good source of that. No, really, really interesting to talk to you as always, Robin. Thank you so much for your time. Appreciate it.
Thanks, Gordon. Thanks, everyone.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.